Good afternoon, everyone. My name is Faika, and today my group mates Natalie, Faith, Manning, and I will be presenting on our financial management CA2 project. So these are the table of contents that we'll be presenting. And the company that we have chosen for this project is Singapore Post, also known as Singpost. So now I'll be talking about the brief overview of Singpost. So Singpost is a prominent player in the integrated freight and logistics sector, not only within Singapore, but also on an international scale. So the company operates in multiple regions, including Japan, Europe, New Zealand, Hong Kong, and Australia. And apart from that, Singpost is also renowned for its extensive network and innovative solution. They also offer a broad range of services from postal and logistics services to e-commerce logistics and property management. So looking at the history and milestone of Singpost, it has actually evolved significantly over the years. Singpost has become an independent department in 1858 and introduced Singapore's first postal code in 1950. And in 2003 as well, it was listed on the Singapore Exchange, which solidifies its market position. And more recently, in 2015, Singpost has pioneered UAV parcel delivery, and in 2017, they have also launched the Smart Post initiative, incorporating digital technology into postal operations.
Moving on to the risks faced by Singpost, first up we have the systematic risk, which in this case is inflation. Inflation causes Singpost's overall expense to increase drastically. This is because the rising cost of goods and services like wages, fuel for transportation, storage, and other additional logistics. This would mean that the profit earned by Singpost will decrease, and it is quite difficult for them to earn it back as they are unable to add on these costs onto their customers. This is justified by this article by Business Times, which states, to make matters worse, costs had risen for the division for fuel, labor, and utilities due to high inflation from the ending of 30 June 2022. Next, unsystematic risk, where the arbitration over a share purchase dispute poses an unsystematic risk for Singpost. This will potentially lead to their significant financial and reputational consequences. These specific legal issues will introduce uncertainty and will impact Singpost's profitability and operations. This emphasizes the need for effective risk management. Next, to calculate the required rate of return for Singpost, some assumptions are needed to be made. These assumptions are from various websites, and we use the data of 12 July 2024. First, for the beta, 5-year monthly, we got a 0.60. We got this value from Yahoo Finance. Next, for the risk-free rate, we based it on the latest yield of 10-year Singapore Government Securities Bond, SGS bond. The risk-free rate we got was 3.10%. And for the market return, we got it from the STI website, and we got a 4.7%. Next, in order to calculate the overall required rate of return, we have to substitute the values we got into the CAPM formula. To find the required return on Singpost stock, we have to take the risk-free rate of return plus beta for Singpost stock times market return minus risk-free rate of return. After substituting the values in, we will get 3.10% plus 0.6 times 4.7 minus 3.10. Because we need to calculate what's in the bracket first, 4.7% minus 3.10% will equal to 1.60%. That is the market return minus risk-free rate of return. Next, we will need to times the beta with the value that we just found, 0.6 times 1.60%. We will get the value of 0.96%. To calculate the finalized required rate of return, we will need to add the 0.96% with the required return on Singpost stock, which is 3.10%. This will give us the final required rate of return for Singpost of 4.06%.
Moving on to question 1D, we want to find out the price of a Singpost share using the constant growth rate formula. Firstly, let's look at the formula in depth. PO is the expected price of a stock, which we want to look for. D1 is the expected dividend of next year. K is the required return, and G is the growth rate. Among all these unknown variables, we need to find out expected dividend and growth rate. We already have required return from question 1 part C. So, to find both of these, we have to make some assumptions. We'll be using average annual growth rate, or AAGR, instead of growth rate as a projected value. So the equation for AAGR is ending value divided by beginning value minus 1. To find dividend, we'll be using the future value formula with AAGR. Now, using data from Singapore Stock Dividend website, we calculate the growth rate of Singpost from 2021 to 2023. For 2021 growth rate, we take 0.022, the dividend in 2020 for the beginning value, and 0.011, the dividend in 2021 for the ending value. Minus 1, we get negative 0.5. For 2022, we do the same but take 0.015, the dividend in 2022 instead for the ending value to get 0.36. Lastly, for 2023, we take 0.006 for the ending value to get negative 0.6. To get AAGR, we add all these values and divide it by 3 years to get negative 0.247%. Since we got AAGR, we now can calculate for expected dividend. We take the dividend in 2024 for the present value, multiplied by 1, plus the AAGR, which we calculated to be negative 0.247 to the power of 1 to get 0.004518. Now, we can put everything together, taking the required rate of 4.06% calculated in Part C, the growth rate of negative 0.247%, and dividend of 0.004518. We calculate the price of a Singpost share to be $0.00111.
So moving on to question 1E, the share price as of 12 July 2024, the data indicates that on this day, the closing price was SGD 0.4450. And now when we compare the calculated share price we derived in Part D, which was 0.0011, you can see that it is significantly lower than the actual share price. And one possible explanation for this could be because of the instances like Singpost strategic partnerships. And yeah, for example, Singpost recently forged like a strategic partnership with Castpost to enhance e-commerce logistics operations. And these operations aim to basically improve operational efficiency, expand market reach, and increase revenue streams as well. So such strategic initiatives can often lead to increased investor confidence because they anticipate like improved future performance, and this can drive up the demand for Singpost shares, which consequently can push up their share price. So overall, the higher actual share price compared to the calculated price can be attributed to the strategic moves like the partnership with Castpost. And these initiatives are likely to have like a positive impact to the company's performance and investor perception, which can influence the share price favorably.
Moving on to question 1F, we need to find the weighted average cost of capital, or WACC, of Singpost from their balance sheets. Let's look at the formula first. There are two components of the equation we need to find, the long-term debt and common stock equity in Singpost's capital structure. We'll need to find the respective weight and cost for both components. For the preferred stock component of the WACC formula, we do not need to consider it because Singpost does not offer preferred stock. Firstly, let's start calculating for long-term debt. From the balance sheet, we will use trade and other payables, borrowings, and lease under Singpost's non-current liabilities. We chose these as they are significant liabilities that are reflected in the cost of long-term debt. So with this in mind, we calculated for total long-term debt to be 692211. For the current share equity, we took ordinary share value from the balance sheet under equity. Now we can calculate the weights for the equation. Using the weight formula for both debt and equity alike, we can use total long-term debt value and ordinary equity to get 0.3804 for weight of debt and 0.6204 for weight of equity. After getting the weights for WACC, we move on to calculate for cost. In the long-term cost formula, we have found that Singapore's corporate tax rate is 17%. So we will only need to find the value for before the tax cost. To do so, we need to find average long-term debt to find before tax cost debt. The equation for average long-term debt is to add beginning and ending long-term debt divided by 2. Then we can get before tax cost debt by taking total interest expense divided by average long-term debt. For total interest expense, we look at the income statement of SingPost under financial expenses. Just like we did for the weight of debt, we take the significant interest expense that aligns with it only. So we take fixed rate notes, bank borrowings, and interest on these liabilities values. Adding it together, we get a total interest of 18326. Now, for average long-term debt, we take total non-current liabilities in 2022 and 2023 for the beginning and ending value respectively, to get an average of 724,736. We can now calculate for before tax cost debt using interest expense of 18326 and average long-term debt of 724,736 to get 2.53%. However, the WACC uses after tax cost debt, so we use before tax cost debt of 2.53% and tax rate of 17% to get 2.10% for the cost of long-term debt. Lastly, we can calculate for WACC of SingPost using everything we've found so far. We take long-term debt weight of 0.380 multiplied by the cost of debt, which is 2.10%, to get 0.797%. Then we do the same for common equity, multiplying 0.620 with 4.06% to get 2.518%. By adding the weighted cost together, we get a WACC of 3.32% for SingPost.
Now let's move on to question 2. Part A, which is about the cash budget template, we were told to prepare a cash budget for Central Perk Cafe, covering the period from July to October 2024. As you can see over here, this is just an overview of what we did, but I'm going to be breaking it down for you right now. So we were told that the projected sales for 2024 were as follows. For July, August, September, as well as October respectively, they were $40,000, $60,000, $30,000, as well as $50,000, which we then inputted into our cash budget template under sales forecasted. Next thing we were told is that cash receipts from the sales are expected to follow the following patterns. 70% will be collected in the same month. For sales collected in the same month, there's a 2% discount for customers. So for example, for the month of July, that would mean that the current month collections for cash receipts will be 70% times the current month's sales, which is $40,000, and their answer will be multiplied by 98% to give the 2% discount for customers. Then, for the 1 month after sale part, 30% of sales will be collected 1 month after sales. That will mean that is 30% times the previous month's sales. In this case, that will mean $50,000 from June, and the following months will follow respectively. Next, the company received $30,000 dividend from each of their investments in July and September 2024, which is clearly shown over here. So the sum of cash receipts made in the respective months will be just a sum of everything we have done, adding them together, which, for example, for July, that will mean $27,000 for $27,440 plus $15,000 plus $30,000, which will give you $72,440. The expected purchases of materials in any given month are 80% of the projected sales in the following month. The firm pays 100% of the current month's purchases in the following month. So this would mean in June, for example, it will be 80% times the following month's projected sales, which will be $40,000. And this amount of $32,000 will be paid in the following month. Fixed salaries of $10,000 for permanent staff are paid monthly. In addition, part-time staff are hired based on 10% of the projected sales in the following month. All salaries are paid in the following month. So what does this mean actually? This means that the base amount that you should be paying for every month will be $10,000 for permanent staff. And in addition, you will need to pay 10% of the projected sales in the following month. So this would mean that 10% of $40,000, for example, for July, will be needed to pay the part-time staff. Rent expenses is estimated to be $12,000 per month. In the following month, where sales expect to exceed $45,000, in the months where sales expect to exceed $45,000, the company will need to pay an extra rental space of $5,000 per month, and all the expenses are paid in that month. So this one is pretty straightforward. So the base rental price that you will need to pay is $12,000. Then for the month where sales exceed $50,000, such as June, August, as well as October, you will need to pay an additional $5,000 for your rental space, which will be a total of $17,000. Insurance premium for the following year will be paid in the month of August 2024, which will amount to $20,000. So this is only one value pretty straightforward, which is shown over here. Other miscellaneous operating expenses in 2024 are as follows. For July and August, it's $700, and for September and October, it's $800. So we've inputted it under miscellaneous operating expenses in our cash budget template. New roasting machines will be acquired in August 2024, and the replacement cost will be a total of $80,000 each. However, since $80,000 each has not been charged to our account yet, each installment, then they tell us each installment is paid in cash amounting to $8,000 per month starting in September 2024. So this is shown in our cash budget. Since starting in September, which means September onwards, we've only put it for September and October. Next, there's a loan repayment of long term in $2,100 in September 2024, which is shown over here. The company will also pay their shareholders dividends amounting to $2,000 in August 2024, which is shown under dividends over here. So the sum of cash disbursements made in each respective month will be the addition of all these that we have done. For July, for example, that will mean $48,000 plus $32,000 plus $14,000 plus $12,000 plus $700, which will give you a total of $58,700. So the last thing that we were told is that Central Park Cafe currently has a cash balance of $50,000 at the start of July 2024 and wants to remain a monthly minimum cash balance of $50,000. If the ending month balance is above $50,000, the funds are brought forward to the next month. So what does this mean? Now, let's have a look. Since the net cash flow for the month of July is a positive $13,740, that will be added to the beginning cash balance of $50,000. So the ending cash will be $63,740. And the ending cash balance would be, the final ending cash balance will be $13,740. So since this amount is an addition, it's like on top of the $50,000, it will be brought forward to the next month, which is shown over here at the $63,740. Then, since the ending cash balance for this month is a negative amount, you will take $63,740 minus $50,540, which will give you $13,200. So then the final cash balance amount will be $36,800, which is a negative amount. So it's a bit confusing, but basically all the values here are linked and you need to move from one month to the other.
So moving on to question 2b, as you can see in July, our net cash flow was $13,740, but our ending cash balance was $63,740, and this gave us an excess of $13,740, which is above our minimum requirement of $50,000. Moving on to August, we see a net cash flow of negative $50,540, resulting in an ending cash balance of $13,200. And here we encounter a deficit of $36,800. In September, it presents a similar challenge with a net cash flow of $8,680 and an ending cash balance of $21,880, which leads to a deficit of $28,120. And finally, in October, we have a net cash flow of $57,500. However, our ending cash balance is a negative $15,620, which result in a significant deficit of $65,620. So the maximum line of credit required by the company is $65,620, and this figure represents the highest deficit that we observed during the period, and it indicates the largest shortfall in our cash balance compared to our minimum requirement. So therefore, this amount is essential to bring our cash balance up to the necessary $50,000. And by securing this line of credit, SingPost can effectively address short-term cash shortages and ensure financial stability as well. With that, we end our presentation. Thank you so much.